Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today on the pod, we're finding out about what's new at CAIA in terms of topics, research, and more. We're speaking with Arron Filbeck, CFA, and he is the Managing Director at CAIA. Prior to joining CAIA, he was a portfolio manager and analyst at Joseph Capital Group Capital Management. He has also been a board member at CFA Society Columbus, CFA Society Philadelphia, and he is an adjunct professor at Penn State University. He has both his master's and BS from Penn State. So welcome to the podcast, Arron.
Great to be here, Rob.
It's a little surprised we haven't done this yet.
I know this is like 10 years in the making.
I know. I'm super keenly interested in hearing about from you as a person who is responsible for a lot of the thought leadership at CAIA about what you have coming up, because so many people who are members of CFA New York also have CAIA distinction. It's exceptionally helpful for them to hear about what's new. So what's new?
Yeah, well, we're at a very exciting point in CAIA's trajectory moving forward. And I think first and foremost, we have a new CEO. So John Bowman recently stepped into the leadership role here at CAIA Association. And I would say over the next 12 months or so, we're really on a listening tour with our members, with the broader investment community, trying to figure out, one, kind of the future direction of where CAIA is headed, but also to some of the things I'm sure we'll talk about, what is on the hearts and minds of what's going on in investments. So what's topical, where should we be focusing our research, and how should we be, as an association, as a membership body, positioning ourselves for the future. So there's a lot to unpack there, but it's a very exciting time here at CAIA.
Well, from a research perspective, just from an analytical perspective, that's exceptionally important, because my sense is, here we are on May 13th, everyone's kind of holding their fire. Like no one's doing anything.
Yeah.
Because it's exceptionally dangerous time to do something. But once you look beyond whatever the temporary, this quarter, this half are going to be, what are you hearing from people right now? I know it's your beginning, so it might get changed a little bit, but just anecdotally, what are you hearing?
Yeah, well, and it's funny. We put out at the beginning of the year, before any of this happened, a content agenda for the association, which was kind of bookended in the calendar year, which is a bit arbitrary from our perspective. But some of the things that we're trying to focus on as an association is longer term than just what's going on over the next 3 months, 6 months, and 12 months. So identifying what's around the corner. One of our taglines is "Next is here." And the idea that as CAIA and as association, we're kind of guiding people to look around what's going on here in the present and focus more on the future. So if there's a couple of things that I would point to, there's three that I'll talk about, and I'm happy to go into a little bit more depth. One is an overarching theme, and I think this is going to dominate a lot of our research and conversations, roundtables that we're putting on around the world, and it's this idea of a great convergence, and the idea that there is a blurring line between what was once public and private and very distinct asset classes and categories for investors. And those lines are going away. They're blurring, whether it's through capital formation and the relationship between parts of venture capital and private credit and buyout and the public markets, public debt markets, and so on. Product development as well. We've seen some very large, high-profile announcements from the likes of KKR and Capital Group. We just saw Blackstone, Wellington, and Vanguard make an announcement on their partnership. And the idea that these big, giant behemoths that have historically operated separate from one another are coming together to offer portfolio solutions, products that are blending those very historically distinct asset classes together. So there's a whole bunch of different tangible impacts to investors as they think about asset allocation and building portfolios. So that's point number one. I think related to that is kind of the overarching theme. There's two that I'll highlight, one on the institutional side and the other on the private wealth side. So on the institutional side, roughly a year ago, CAIA introduced this concept known as the total portfolio approach. And this was a long-form paper that we put out highlighting a couple of asset owners that have embraced this new way of thinking about asset allocation and kind of thinking about the overall portfolio in a holistic sense instead of breaking down those silos and thinking in terms of asset classes. So back to this great convergence, let's think through the overall portfolio objective and how we approach that. And that has implications from governance to incentives to culture, but also how you build a portfolio, whether it's through factor exposures or comparing things on a more apples to apples basis, public or private. So this is a very exciting topic for us. And one that we're actually exploring even further, and we'll have some more follow-up research on that later in the year. So that's point number 2. And then the third and final is obviously this huge move towards wealth management. So historically, private markets alternatives, and I'll put air quotes around alternatives, were historically only for the institutional investors. So the endowments, the pensions, the foundations, sovereign wealth funds. And they are very heavy allocators to a lot of these different categories. The wealth channel is very new. And you look at the average allocation to private markets, and depending on the level of assets and sophistication, it's anywhere from 1 to 7%, name it. And a lot of these partnerships that I just mentioned at the very beginning are geared towards the wealth channel and trying to deliver new product, new strategies to high net worth individuals, financial advisors, and wealth managers. So it has all sorts of implications for the advisor, the allocator to these products, but also a lot of these asset managers and GPs are building out their distribution strategies. So I'll pause there.
Right. So let me just ask you a clarification question there, because it's exceptionally important. What do you mean by wealth? Are we talking about, people with $2 million in house value and a couple $1 million in the bank, or are we talking about $20 million or $50 million in a family office?
Well, I think it's probably a little bit of all the above, but if you think about this visually, it's a bit of a, you're filling up buckets and then they spill.
Right.
So you're starting with the wealth, and I'd say where the heaviest allocators are the family offices.
Right.
So anywhere on average, 15 to 25% allocations to private markets, which is somewhat on par with what you see on institutions. Endowments are at the extreme end of 50, 60%. Pensions are somewhere around 30% or so, depending on the plan.
Depending public and where they are, and
depending on where they are. But family offices are the heavy allocators, and then you start to move down to the ultra high net worth space. So perhaps allocations and net worth that's in the 10 million, 20 million plus. You move into the high net worth space, 1 to 5. And then anything below that, more mass affluent type of profiles. And the allocations currently just get smaller as you move down.
Right.
So that when we define wealth, and to your point, it's a very broad definition, but the level of interest and allocations differ across those different groups.
Right. And they're also serviced by exceptionally different sort of organizations. Right. As you go up and down that panel too. That's one of the things that was exceptionally interesting to me as a person who started my career in wealth management. We used to, I worked for the wealthiest people, average 200 million. We used to call the people that are in the wealth management realm the merely wealthy.
I was one of the people that worked in that realm. So most of our clients were in that kind of 1 to 10, let's say on average. So we were the merely wealthy.
Right, but in the last 20 years, there's an explosion of the number of those people.
Oh, absolutely. Yeah.
And it's probably going to keep going.
And there's a massive opportunity if you're a GP. And obviously there's a diversification element and a desire for differentiated sources of returns for the client and the advisor who's trying to think through diversification towards a long-term plan. But if you look at the products that are being developed, you see why, because there's a massive opportunity when it comes to revenue generation from the GPs. You see fee compression in the public markets. There's a bit of a moat around fees currently in the private markets. And I did a back of the napkin math exercise earlier this year, and ultra high net worth individual allocations were somewhere in the neighborhood of, let's say, 4 trillion. Overall to alts as an allocation. Right. And overnight, if you just got it up to 5 or 10% on average, it doubled that AUM. And that fee opportunity is also massive. So there's a bit of a supply and demand crashing coming together. Right.
And it also appears to me, this number gets exaggerated a lot sometimes, so I'm not going to try and put a number on it. But by the by, there is a bulge in our population, and those people are going to hand some of their wealth on to their next generation, which means potential for change in attitude towards all types of different investments.
Right.
And that is the thing that I think is the bigger change, rather than just the explosion of this $1 to $10 million folks, is the change in the attitudes.
I think the change in the attitudes, which has impacts on asset classes, we'll see where crypto goes, but that was a very popular thing with the younger generation. The other thing that I think is important here is the attitudes towards access. That older generation is used to the paperwork, and it's almost a rite of passage to have to go through all this laborious whatever. And then if you're a younger generation, you want it on your phone. You want it easily accessible and to be able to point and click like you can an ETF or your Robinhood account or whatever.
Yeah. And that paperwork was also a gate.
It was.
Right.
It was.
Yeah. And so this current generation doesn't believe in gates. Right.
No. And I think it's for the better. The access should not be gated because of the operational hurdles. It should be gated based on AUM, sophistication and education, and your ability to withstand market events, illiquidity. Like we should be changing the gates to be more around, is it right for you? Is it right for your client?
Right.
Not is it a headache to actually sign papers?
Right. It should be appropriateness.
Absolutely.
Period. Full stop. Right. It's I think it's going to be exceptionally healthy. Well, so I guess one of the other things I'm curious about is do you have any hot topics in your events or other things right now that would be interesting for people to hear about as they're trying to sort of plan out their events, or just, they are CAIA members and want to use it?
Yeah, well, it's funny. I can't go to a conference without private credit being the topic du jour.
2 years of that.
Yes, and it's funny. It has been 2 years of that. So I would say that private credit is still a very hot topic. What has changed in my view is how we talk about private credit. So maybe a couple of years ago, a lot of the focus was on direct lending, senior secured, middle market.
Yep.
And that's still there. And that has been the growth engine in private credit over the past 15 years. But what I'm starting to notice is that people are interested in talking through other parts of the ecosystem. So that's venture debt, that's asset-based lending, it's mezzanine. And I think part of this is because there's been so much competition that's moved in direct lending, and spreads and dispersion have come in. And so products have come to the market. So again, this supply and demand. You have a demand for differentiated source of return. On the supply side, you have GPs that want to look different from their competitors. And so that has been a more recent conversation around different flavors of private credit. The other thing I'll say on private credit is that it is not all rainbows and sunshine anymore. And, we'll see how long some of these geopolitical, tariffs and attitudes continue on, inflation potentially coming back, but how well does private credit actually stand up in an environment where some of those assumptions that led to its success in the past 10 to 15 years are continuing to be challenged? These are costs to companies at the end of the day.
Well, I wonder also if you're seeing this, because I've been hearing this anecdotally, but I haven't seen any evidence of this, is just the stuff that happens when any market is in favor for a while. There's some deals lying around with some hair on them. Right.
There are, and there's new managers that enter into the market that, there are obviously some GPs and some managers with very long track records that have withstood some challenges, but you have a lot of newcomers. And, what happens when there's a prolonged, now with private credit, you're not mark to market like you are in the public markets. And so you can kind of, and the benefit of private credit is that you can work with these portfolio companies. And so whether that's extensions or it's PIK loans or whatever to kind of help them withstand the loan. But how long that goes on, we'll see.
Yeah, and there's a secondary market. There's some other things that is growing.
So I think private credit is a big one. AI is on everyone's mind. The funny thing about AI is that I don't think anyone knows how to deal with it. So there's a lot of talk around it's going to change things. You've got to be upskilled. But I don't know that we've completely figured out what that actually looks like in terms of upskilling. So that seems to be creeping more and more into events and research and areas of interest. We just did a survey with our membership, and AI was one of the biggest areas that they're nervous about, but they also see an opportunity in. And how to navigate some of the noise versus kind of a longer term signal, I think is important. And then the third thing, ironically, we were talking about crypto earlier. I'd say the conversation has moved back to the technology. So we kind of had a technology conversation around digital assets early on. Then prices went up. Bitcoin, hit all-time highs, and so it was all about cryptocurrencies. And today, I think we're back to more of a balanced conversation around the benefits of the technology, but also how do you access it and integrate it into an investable portfolio. And that's private markets, it's direct ownership, it's equities, and so on. And the final thing I'll say on crypto, and then I'll shut up, is the global landscape of adoption, and when it comes to regulatory embracing of crypto. I think that is very different when you look at different markets.
Yes.
Parts of the Middle East are much more open to this than the U.S. is, although that seems to be changing. We'll see how that potentially goes.
Yeah.
But different parts of the world and different pockets have become digital assets hubs that are outside of the U.S. We're not leading this conversation.
Well, right. I mean, that was a rather conscious direction starting, years ago when basically the expenses to do it and the registration issues for miners were so onerous that everyone moved offshore.
Yeah.
Right?
No, totally.
And now I'm not sure that moving miners offshore is a real big risk in a developed market where we have skills.
Mm-hmm.
Mining is a hard business to keep going. It's not a high yielding business.
Yeah, I'll take your word for it.
It's
do you have a mining system here in the office?
Yes, we do. It's that giant closet over
there
with the 20,000 pounds of air conditioning equipment.
Yes, exactly. Well, I think the other thing is people are excited about the U.S. potentially embracing digital assets and the technology and Bitcoin reserves and all that stuff. But you have to remember that it's the Wild West now.
Right.
And so when you start to embrace some of this stuff and you actually put some frameworks and regulation around it, not everyone's going to be happy about it. We did a podcast on this, and that was a big aha moment for me where, yes, we may embrace this as a country from a policy perspective, but it's a lot easier when there's kind of nothing to go off of.
Right. The comparison to nothing makes it sort of attractive. We've had a couple of people on the podcast who are doing sort of nice, interesting things with AI. We had someone on the podcast who developed an interesting model for tracking sentiment.
Mm.
So it's not really a whole separate thing. A lot of portfolio managers or economists look at sentiment numbers all the time.
Sure.
It's just a way of kind of taking out some of the drudgery of that work.
Yeah.
And putting it in one place. Now, I did it. It's also not easy to get together. It's not hard if you have some skills, but it took me about 2 hours to figure out that part of the problem was I was on a Mac and didn't have Python 3 installed.
I see. Well, I think the other thing, and you look at some of these open source LLMs, ChatGPT and so on. I think where the real opportunity will ultimately lie is when you start to do intranets instead of relying on the internet. I mean, there's so much garbage that's out there, and so it's garbage in, garbage out. So whether you're a law firm or you're an investment organization that has got your proprietary information and the ability to look across your entire organization in terms of views from your analysts or memos, that is a huge opportunity. I think on the LLM side and sentiment. You're relying on kind of a cesspool at this point. I mean, the internet's just like...
Yeah, I mean, it is one of those things that does hit a CFA charter holder right in the teeth, right? Is like, I can't tell where this is all coming from, so guess what we're not doing? Yeah.
Yes.
That's the problem. Yes. It's fascinating. So I wonder if we get down to brass tacks, because we are in a massive amount of volatility. A lot of people are a little bit concerned about their jobs, no matter where they work. Even the people in quant who are, who are hiring like crazy, that seems to have slowed down a little bit. So where are jobs in alts right now?
Well, I think the jobs in alts are, I think it's a massive opportunity. I mean, and I'll give a couple of maybe big stories. I mean, obviously each organization is a little bit different, but back to the example that I talked about with this great convergence, these large, historically traditional asset management firms are now buying and building their alts capabilities. And whether that's acquiring boutiques and trying to integrate them into their business lines, Franklin Templeton's, BlackRock's has had several examples of this over the past couple of years. You need people in order to keep those trains going, and that's distribution. It's obviously investment professionals to keep everything going. The GPs are also growing massively as well, and so I think there's an opportunity in distribution. Again, this whole move to wealth. These GPs have historically operated in the institutional realm, and so if you're going more retail and more high net worth individuals, you need to build out your distribution capabilities from that perspective. Of course, as AUM grows and new products come, you need analysts and associates that are going to develop those. So I think that this is a growth area for our industry, whereas maybe other parts have struggled or there's been some rationalization from that front. So obviously, it's not all positive, and there's all sorts of examples where that has come up. But
it never is.
I think at an aggregate level, this is an opportunity. The AUM in alts is now sitting at about 25 trillion in assets under management.
Okay.
And just 20 years ago, it was closer to 5.
Yeah.
So we have it has grown massively since then, which brings opportunity.
Yeah. Well, it's exceptionally interesting. So, are you planning any written materials to come out pretty soon? Because we have a bunch of readers in CFA land. So.
Yeah. Well, I mentioned TPA.
Yeah.
So we're doing a follow-up piece. And really, last year we talked a lot about the concepts of TPA and some of those pillars behind the approach of TPA. Now we're exploring, how do you do this? Like, what does the implementation look like, and what does the transition look like, going from a SAA fill up your bucket type of mentality to a TPA kind of joined up portfolio mentality. So we're in the process of exploring that. We're writing a longer piece on this, and that'll be out later this year. One of the things that we're also working on, and you can see this during our listening tour, is this as we go and have these round table discussions around the world, and we've got the membership surveys that we're doing, and we're interacting with a lot of the different parts of the investment community. We're writing about it as well. So we're very publicly sharing, here's what we're taking away from a lot of these different conversations. So that's not a big, long white paper. That's 50 pages, but we'll have a lot more to share over the course of the year as we interact with some of the thought leaders and industry leaders across the private market space.
Cool. Well, so perhaps we should leave it there on a high note. If you're listening to this podcast and you have an idea for CAIA, find Arron on the listening tour. Find the feedback survey.
We want to hear from you.
Yeah, make your voice heard. It's the only way that organizations like ours get better. So thank you for being on the podcast, Arron.
Thanks for having me, Rob.
We'll have to do this again soon.
Absolutely.
And thank you all for listening to the podcast. If you are a member of CAIA and CFA New York, please have a look at some of the events coming up. And until next time, I'm Rob Rowan, and this has been Compound Insights.